Retirees invest their savings for two reasons. They either need to offset their ongoing spending and inflation on that spending, or they need a small amount as a percentage of their total assets to sustain their lifestyle and their ongoing spending needs. So they're hoping to leave a potentially larger inheritance to their future beneficiaries. If you fall into one of these categories, here are some very common retirement investment mistakes to avoid. The first mistake is prioritizing spending down your cash and your bonds just because stocks have been doing well. It's natural to not want to sell something that's been doing well. But when you're retired and you're spending disproportionately from your cash and your bonds, your overall exposure to stock will rise. This may not be an issue for somebody who's not spending down their money, but for those who are, this can be a major problem, especially if we experience a long-lasting downturn in stocks. So how can you avoid this? You can either use your target allocation between stocks and bonds as a guide to determining what to sell when you're taking withdrawals from your accounts, or you can simply look to sell more stocks if they've been doing well for a long period of time. Effectively managing your asset sales to fund your withdrawals in retirement can make the difference of years in terms of your money lasting longer. The second common retirement investment mistake for retirees who are spending down their money is investing too much of their bond money or their safe money in diversified bond funds. Diversification is a crucial part of investing, but it's important to not unintentionally assume one risk when trying to reduce another. For example, if you're retired and you're spending off your money and all of your bond money is invested in bond mutual funds, you may be well diversified, but you may also have high interest rate risk. This is when market interest rates rise, leading bond prices to decline. During a normal period, it would be reasonable to expect that your bonds will hold up okay, and they may even rise during a period of sharp decline in stock prices. But this isn't always the case. Take the year 2022, for example, when both stocks and bonds were collectively down by more than 10%. So how can you avoid this? Well, if you're retired and you're regularly spending off your money, you need constant liquidity, then you might maintain a solid base of cash and savings in your checking and your savings account, as well as maybe a money market. And in addition to that, what you can do is you can calculate how much money that you would need to meet just a few years of your regular spending needs, and you can carve out that portion or that sum of money from your bond portfolio, and you can build a bond ladder using individual bonds. Now, the difference between individual bonds and bond funds is it's not that they won't go down, but the difference is that you have an individual bond, when it comes due, you get your money back, whereas in a bond fund, when a bond comes due, they're generally redeploying that money into another bond. So from an interest rate perspective, having money in individual bonds can insulate you from having that interest rate risk if rates rise sharply and bonds generally are down in value. If you have an individual bond ladder, you have bonds that are constantly coming due, giving you liquidity to ride out that volatility with the bond markets. The third common retirement investment mistake to avoid is allocating too much of your money to insurance products. Insurance products like annuities can make sense for the right person, but with all of their guarantees comes a complicated cost structure and illiquidity. So by over-allocating to insurance products, it can be really easy to unintentionally inflict more damage from the opportunity cost than the benefit that you're earning from the guarantees. So how can you avoid this? Well, for starts, don't over-allocate your money to insurance products. Don't have a significant portion of your wealth in any insurance products like an annuity. It's not necessarily a bad thing to have some of your money in an annuity, but don't over-allocate to them. And another thing you can do is to consider non-insurance products that also offer guarantees. The guarantee may not be for income for life, but there are plenty of investments that offer guarantees of principal. For example, certificates of deposit offer, limited protection by the FDIC, and treasuries, they also offer protection. They're guaranteed by the government. And you may say, well, the bank or the government, maybe they don't make good on their debt, so how can they be guaranteed? But I would push back because that's the same case for insurance products. They're guaranteed by the claims paying ability of the insurer. Anyway, it's just really important to do your own due diligence and remember that too much of anything is rarely a good thing. Mistake number 4 is investing your money either too conservatively or too aggressively. Most people require some level of growth to sustain their ongoing spending needs and inflation in retirement. So by investing too conservatively, you can seriously jeopardize your ability to meet your spending needs during your later years. And alternatively, by investing too aggressively, you're increasing your odds of needing to sell investments when they're down in value, which would also potentially shorten the life of your portfolio. So how can you avoid this? Well, you can consider your investment strategy not only from the context of how much liquidity you need and what your risk tolerance is, but also in the context of how much growth that you need to meet your long-term goals. I hope you found this video helpful. If you have any questions about your investment strategy or just simply feel that you'd benefit from a discussion with me, then please feel free to schedule a meeting, a complimentary consultation. There's a link in the description of this video. As always, I wish you the very best of luck, and I hope to hear from you soon.